We are past the warning phase. What is happening now is not anticipation, it is execution. The silver market did not break today because of price. It broke because of timing. It broke because movement stopped being guaranteed at the same moment demand became non-negotiable. That is the condition every paper market is designed to avoid. And yet, here we are. As of this moment, there is no single global price of silver. That idea still exists on screens, but it no longer exists in logistics, contracts, or inventory behavior. What the market is experiencing is not volatility, it is fragmentation. In Shanghai, silver is trading as a strategic input under imminent restriction. In the Middle East, silver is trading as a scarce physical commodity under stress. In New York, silver is still trading as a financial abstraction, detached from immediate delivery risk. These are not price discrepancies, they are jurisdictional realities. This distinction matters because arbitrage depends on three things: price gaps, time, and certainty of movement. The China export ban removes all three simultaneously. Licensing removes certainty. Border enforcement removes time. And once time disappears, arbitrage stops being a mechanism and becomes a theory. That is why spreads are widening instead of collapsing. That is why no one is closing the gap. Not because traders are incompetent, but because traders understand that metal cannot be moved fast enough to monetize the difference. New York is not cheap silver, it is stranded silver. This is why delivery behavior matters more than charts. When participants stop rolling contracts and begin demanding bars, they are not making a bullish bet. They are exiting a system they no longer trust to perform later. Delivery is not speculation, it is conversion. The surge in delivery requests is the clearest signal we have. A 26-fold increase in physical demands is not noise. It is a coordinated shift in behavior. Large entities looked at the calendar, understood the implications of January 2nd, and decided that paper exposure is no longer equivalent to metal exposure. This is the moment where paper liquidity turns into physical liability. Bullion banks function normally as long as confidence remains intact. They sell paper claims, assuming settlement will be deferred, netted, or rolled. The moment counterparties demand immediacy, that model collapses. Banks are forced to source metal in a market where metal is already scarce and priced higher elsewhere. That creates a balance sheet problem, not a trading problem. Every ounce delivered below replacement cost destroys capital. Every forced settlement tightens liquidity. This is why emergency funding appears not after price spikes, but after delivery spikes. Cash is required to bridge losses created by structural price divergence. This is also why central bank liquidity operations should not be misinterpreted. They are not attempts to suppress silver. They are attempts to prevent settlement failures from cascading into the broader funding markets. The objective is continuity, not control, but liquidity cannot solve a physical constraint. It can only delay its expression. At the same time, inventory withdrawals in Asia reveal something even more consequential: strategic accumulation. The pace of withdrawal is incompatible with normal industrial usage. This is not production demand, it is preemptive capture. Once silver is reclassified internally as a strategic reserve, it exits the global float permanently. Those ounces do not return. They do not respond to price, they respond to policy. This is how markets bifurcate. Not through panic headlines, but through silent inventory decisions made before rules change. By the time the ban becomes law, the metal is already gone. What remains is a paper price trying to adjust to a reality it can no longer access. That is the fracture, and it is already irreversible. What comes next will not be clean, and it will not be fast. The reason is structural. Markets like this do not resolve through price discovery once movement becomes conditional. They resolve through hierarchy. This is the part most observers misunderstand. They keep waiting for a candle, they keep waiting for a headline, they keep waiting for a moment when the chart finally reacts. But charts are downstream. By the time the chart moves, the real event has already happened somewhere else. The real adjustment occurs in logistics, contracts, and permissions. When a commodity can no longer move freely across borders, price stops being a global signal. It becomes local, political, and strategic. At that point, the market does not ask, what is silver worth? It asks, who gets silver first? That question has only one answer: whoever cannot afford to stop. Industrial buyers are the highest priority actors in this system, not because they are morally important, but because they are structurally inflexible. A hedge fund can roll a position. An ETF can rebalance. A bank can net exposure. A factory cannot roll a production line. This is why industry always wins access battles before price battles even begin. Once procurement departments internalize that price no longer guarantees delivery, their behavior changes immediately and permanently. They stop optimizing cost and start optimizing certainty. That means longer contracts, higher premiums, private sourcing, and preemptive inventory accumulation. This behavior does not show up on exchanges. It happens quietly, off-screen, and weeks before retail notices anything wrong. This is why shortages feel sudden to the public. They are not sudden. They are simply invisible until they are unavoidable. Retail markets experience this phase as nothing makes sense. Spot prices appear calm. Headlines remain neutral. But availability deteriorates rapidly. Shipping times extend. Product limits appear. Dealers stop quoting firm prices and move to call for availability. Those are not normal frictions. They are rationing mechanisms. Rationing is how systems preserve themselves without admitting failure. This also explains why paper markets continue to trade even as physical markets tighten. Paper markets do not require delivery. They require confidence. As long as participants believe settlement can be deferred, paper liquidity can appear abundant even when metal is scarce. But confidence is not stable under stress. It erodes asymmetrically. The first actors to lose confidence are always those closest to physical risk: refiners, manufacturers, logistics firms, and large commodity users. Financial actors lose confidence later, usually after delivery behavior changes. That sequence matters. By the time financial markets recognize the problem, inventory has already moved. The metal is already locked inside domestic systems, long-term contracts, or strategic reserves. At that point, repricing becomes violent because supply is no longer elastic. This is why convergence does not happen smoothly. It snaps. Attempts to force convergence through paper mechanisms only accelerate distrust. Futures cannot compel exports. ETFs cannot override licensing. Liquidity cannot substitute for atoms. When these tools fail to deliver, they expose their own limits. That exposure is what breaks trust. Once trust breaks, behavior changes irreversibly. Participants stop assuming that tomorrow's delivery is equivalent to today's delivery. Time itself becomes a risk factor. Deferred settlement becomes a discount, not a convenience. This is the phase where paper instruments lose their hedging function. A hedge only works if settlement is credible. When settlement becomes conditional, hedging transforms into basis risk. The spread between paper and physical becomes the real price signal. That spread is not noise. It is information. As the spread widens, it tells you that the system is prioritizing stability over transparency. It is telling you that price discovery has been suspended in favor of access control. This is not manipulation in the traditional sense. It is governance. Markets under stress are governed, not discovered. This governance expresses itself through delay, allocation, review, and silence. Phones stop ringing. Quotes disappear. Withdrawals enter queues. None of these actions announce crisis. They manage it. The irony is that these actions often deepen the very problem they are meant to contain. Each delay confirms suspicion. Each review signals scarcity. Each restriction incentivizes preemptive action. This creates a reflexive loop. The more the system tries to slow demand, the more demand accelerates toward immediacy. The more immediacy is demanded, the more the system restricts. This loop cannot be broken by price alone. It ends only when a new equilibrium forms. That equilibrium will not resemble the old one. The previous silver market assumed global fungibility, frictionless movement, and infinite rolling. The new silver market is defined by jurisdiction, priority, and strategic relevance. Price will still exist, but it will no longer be the primary allocator. Access will. This is the shift that most investors miss because it does not look dramatic on a chart. It looks administrative, it looks procedural, it looks boring, and that is exactly why it is dangerous. By the time the story becomes loud, the inventory is already spoken for.